Good morning, everyone. Welcome to the Flow Show once again. It's Wednesday. Welcome to all our Eightcap colleagues who are joining us today as well. Obviously, these guys and girls can come and join us every day of the week. We're here all week. And welcome to Stelios and K-Man, my colleagues. Good morning to you, boys.
Good morning, Ryan.
Hello, everybody. Hi, Ryan.
Hope you're doing well. Hope you guys and girls can hear us all fine and dandy. Let us know in the comments if you can't, any problems. Right, got a bit to get through today. Lots coming up later on in the session, but we'll go over a few bits and pieces as we usually do, some of the headlines and things we've seen overnight. We'll start, as we often do, in China. Had a few more lockdowns in Shanghai, a few more cases rising over there, continuing to keep an eye on what's going on over there. As to what's going on with the lockdown situation. Is it going to develop into something bigger again that causes shutdowns? But we're getting some minor pieces of information out from China. Crude imports for June were the lowest since July 2018. So for any people who are watching oil, that's one thing to factor into the, let's call it the risk, the commodity space there, because that's going to impact oil prices if they're not using as much as what they should be doing, particularly if they're opening up again. You'd think that the oil usage and demand would pick up. But it posted lowest numbers for 4 odd years there. But on the flip side, the Chinese customs data, they're monitoring the growth activity there. It reversed a downtrend it's seen pretty much since April. So there was growth through May and June as far as customs numbers were concerned. So that again is a bit of a counter to what may be showing from the oil news, is that activity is progressing, movement is happening, particularly through ports and things like that. So perhaps we'll see that feeding through into supply chains easing up. But one of the issues that might happen is that China easing up their side of the supply chain just can create a bottleneck, as we've seen previously in other ports. As if there's a flood of ships moving out of China to other ports, then we get a blockage happening there, and so everything carries on being slow and grinding to a halt, and the backlogs persist. So it's positive news on the one hand, but we need to watch the follow through to see if that really does impact supply chains across the globe. Moving to the RBNZ, they hiked as expected, 50 pips. The message alongside of that was nothing really out of the ordinary. They're going to continue on their hike path. They're going to continue what they're doing, see how the economy is going, fighting inflation, yada, yada, yada. No real change there, as you can see from the Kiwi on the screen. It's and I better change it on the other one as well. 2 seconds. Yep, you got it on there. Kiwi is in fact down, and down towards a 61 handle again. So no respite there for the sell-off in commodity currencies and the Kiwi on the RBNZ. K-Stel, did you pick up anything from the RBNZ numbers or the announcement that sticks out for you?
No, nothing really on my side. I was looking at the yields on after the RBA decision, very flatlined. Little bit of the expected algo spike, and then back to where they were before. It was well telegraphed, the rate hike. Call that one priced in. No, I haven't seen anything new on the Kiwi side in regards to it.
Yeah, and no change to the expected path for rates. So the markets took it in each stride and move on to other things.
Autopilot.
Yeah, exactly.
It was disappointing. I think the Canadian
one is going to potentially bring us a little bit more action today. But,
yeah, definitely.
RBNZ was a big nothing, unfortunately.
Yeah. Now, we did also get some data out this morning. UK GDP came in, perhaps surprising some to the upside. The data looked pretty good all round in the UK. Industrial production was up, GDP was up, construction output was up. This is all for May data. So pretty solid numbers there, which goes a bit against what we've been hearing, the doom and gloom coming out of the UK. Now the GDP, again, this is for May, so it is a bit lagging, so it may not start to see an impact from the recent things that have been going on, particularly like things like the PMIs. So it is a bit old data. Now, one thing I was looking at was the industrial production numbers. And it's possible that we're going to see this part of this data staying fairly strong. And the reason for that is because of all the energy supply issues that may be happening. Obviously the UK gets a lot of its energy from Europe, but we are also a big producer. And so if there's going to be a big pickup in extraction and mining, resource gathering, refining, that sort of thing, it could impact into these industrial production numbers. So that's something just to keep an eye on moving forward as well. Build it into the picture. As I say, the market is very dour about the UK at the moment, with the poster boy, if you like, for whether recession is going to hit and how rate hikes are going to bite. But if we start to see some of this data not confirming that view, that's going to potentially see a big rally in the pound, because the market will be over bearish on the UK. When the case is maybe not that strong to be so bearish. So just keep an eye, and we'll see how that factors into the data. Unfortunately, as I said, it is a bit lagging. So, the PMIs tend to give a more forward-looking or a sooner look at the economy. But we need to see whether this lagging data, which is the headline data or hardline data, starts following the PMIs, and maybe we do see some of that sag coming in. CPI readings from Europe, mainly the final readings, nothing really of note of change at all, mainly confirming the flash readings. Germany, HICP 8.2%, CPI 7.6% unchanged. I always look at the year-on-year numbers rather than the month-on-month numbers. France 0.5 on the Eurozone measure, and 5.8, which up a bit on CPI. Versus the flash number. Spain as well, coming in at 10%, confirming HRCP at 10% and CPI at 10.2%. So inflation is well embedded in Europe. No surprises there. Now, looking ahead quickly, we've obviously got the big US CPI numbers. We've got the mortgage, MBA mortgage data as well, the little weekly number that I like to look at for the housing market. It came off a 3 streak of positive numbers, which came off a big long trend of bad numbers, and it went back down again last week. So going to be watching that to see if the prior couple of weeks was just a blip or just a dead cat bounce, and we're getting on with seeing more weakness there in the housing. But US CPI is obviously one of the big points today. Now, I've been talking about this a bit in our chat room, and I'm seeing a lot of the market getting a bit balled up on expecting this CPI number to perhaps be a peak for CPI. These calls have been happening a lot the last few months. Is this the peak? Is this the peak? Is this? So it tends to tell you what the market is trying to look for. But we got comments out from the White House yesterday. Obviously, we got a bit of a primer saying that it's looking like this number is going to be strong. But they also commented that gas prices had dropped back, oil prices had dropped back, and that's not factored into this data. And I think a lot of the market, as I say, I'm seeing a lot of comments where people are tying, the relative last 5 minutes in oil markets and gas prices into these CPI numbers. Unfortunately, that pass-through doesn't happen as quickly. What we've seen the last 2 weeks in oil does not come through within a month in CPI data. There's a pass-through. It can be sort of 3 to 6 months before you really start to see the effects feeding through from what we see today into future data. So I think the market may be getting a little bit ahead of itself in expecting to see a peak. But what I have been noting within this data is the number. The core number has been dipping. It's dipped the last 2 months on the trot. So whereas CPI is creeping higher, the core number actually isn't. The core number is more domestically inflation. And this, I think, is where the real inflation story is going to be, rather than the headline number. We could see the headline number shooting higher. But the core number, again, it's the pass-through effect. So what we see in the headline CPI number is very volatile. It does take into the impact and things like that. And then there's a lag between that and the core number. So what we might be seeing is a bit of a blow off the top in the core number from maybe what was happening before the Ukraine stuff kicked in, when we saw CPI levels sort of moderating a tiny bit. But what we're not factoring in is things like wage rises. And if you look at something like Europe, where we've got a hell of a lot of strikes happening and people demanding higher wages, those sort of things haven't factored in yet. You know, higher wages are being given out, but you take Germany and they're looking at some of the big industrial associations looking for big pay hikes. Some of those aren't even in the inflation picture yet because they haven't happened. So as far as the core numbers are concerned, there's still a lot of factors that are yet to feed through into those numbers. And if we go back to America, you know, take the rise in price of gas that's happened months ago. That's yet to be fed into inflation. Firms put up transport costs, put up fuel surcharges, pay higher wages to drivers. That doesn't reverse as quickly as the oil price might. And all those pressures still sit underneath the surface and filter through. So long story short, I'm not so keen on the call that inflation might peak with the headline peak, but it's going to be all about that core number. And if that core number starts moving higher as headline inflation comes lower, it's going to create a bit of a dilemma for the market, because that'll be the real inflation number, the core number, and that's what the Fed will be watching. They'll excuse the headline number for all its volatility. So I'm looking to see whether the market mood at the moment on inflation and this calling for a top is potentially going to be wrong, because if it's wrong, that potentially creates some trading opportunities, because the market may get over bearish on the Fed, over dovish on the Fed, and pricing how high they're going to go with rate hikes or when they might have to cut them back. And if we get an extreme move, a big run to the other side of the boat, that potentially is going to create some trading opportunities to counter some of those moves. We also got a fake report circulated yesterday about CPI that it was going to come in at something like 10.1%. That did have a little shock to the market, but that got quickly knocked back and dismissed. So there is a lot of shenanigans going on. It's going to be, as we know from data, it's potentially going to be volatile for price moves. You know, we got 70, 80 pip moves in dollar yen over. We got that on the Michigan numbers before. So data means something to price moves at the moment, and we've got to factor that volatility in when looking at the data. Before we move on to the BSC, any of you guys got anything you want to add to CPI?
Mention is I think the situation is slowly changing in terms of how the market's reacting to these numbers. If you remember, the people who have been following us for weeks and months here, when inflation started picking up, we're always saying, you know, this is not transitory. It's going to be surprising to the high side, and you know, as it turns out, this is how it was. Now, what I'm saying today is that I think the risk for the reaction to the number is now getting a little bit skewed. And what I mean is this: pretty much everybody, you know, everybody I speak to, I read about, I chat with, pretty much everybody thinks, oh yeah, we're gonna have a stronger inflation print than expected. And this wasn't the case before. You know, before people were saying, maybe not, I don't know. Now everybody is sure it's going to beat this. What is it we're expecting again? 8.8 CPI and 5.7 core CPI year on year. I think now the risk for people who want to trade before the number, I'm not one of those people, but people do that. I think the risk is now for an oversized reaction on a weak print. So, you know, it's kind of almost expected that we're going to hit like 9% CPI now. And, you know, yes, inflation is high. It's very sticky, and oil is, energy is high. But, you know, you're going to get prints that are going to be slightly, you know, maybe not on the same trend as they have been. So you're going to get an odd print here and there that is not going to be strong, or it's not going to continue the trend. That's what I think the market move is going to be oversized. So I think now going into today's number, a weak print is going to create a much bigger move than a strong print. So if you get expected 8.8, if we get 9%, we're going to get a move. If you get 8.6%, we're going to get a much bigger move to the other side. That's my view. So just something to be wary of if you're carrying positions into this number. I think we are now shifting finally after months and months of a different scenario, let's say. Now we're shifting, and I think now the reaction is going to be more intense if we get a weak print. Just my personal view, obviously. I could be wrong. I've been wrong many times in the past, but it's a feeling I'm getting from the markets and the way people are positioned, and
No, it's an important point you make, and something I always stress ahead of big data points. Know where the market risk is. Know where the bigger price risk is, and as Estelle says, the market for higher inflation, so the bigger price risk becomes if it misses and comes in on the downside. So you have to match that in and looking at it from today's perspective and what the market is going into it. Kay, you got any thoughts on CPI?
Well, you guys have pretty much said it all, and both sides. So I don't have much to add. I think
you can do the BOC then.
I think the market is hoping for a higher CPI print and a lower core, because that is what the market has been trading so far. You can see it on the rate side, I mean the bond market, the yield side, which is driving mostly what's happening right now, and they are hoping for this, like keep the high on the headline CPI and then lower core, because we are already pricing rate cuts into next year. And for me, the risk is that the bond market or the money market is trying to reprice the curve, try to send it deeper into inversion. And as we've seen, and as I already mentioned a couple of times, that bond traders themselves are surprised how quickly this market is yo-yoing up and down in the yields. We might see a pretty decent yield move again on the back of those CPI numbers. But to me, the big level, if you only take the 10s, is going to be back into those 270s on the 10-year. But personally, I wouldn't hang my head on too violent immediate moves. FX will move. FX will follow the move on the yields, follow the inversion, and then we'll see afterwards. But again, I mean, we've already mentioned it. Last time Powell said that he's looking at the Michigan numbers as well, because that's consumer inflation expectations. So we might have like a case of fading initial moves today, if that's my hunch. But we'll have to see what really happens.
Yeah, and those Michigan flash numbers are on Friday, and they're going to be closely watched. So it could be a complete do from the CPI to those numbers. CPI could come in really hot today. We see bond yields rising, dollar rising again, and then inflation expectations dump on Friday, and we go into reverse. So again, the data is volatile for prices at the moment. You have to take each piece of data as it comes and know your risk going into it. But as Kay rightly says, sorry, mate.
On the other side, we'll have to look at 3.25. So you basically have 50 BPs, which is, by the way, a very big range for people who have been long in the markets. If the 10s move 50 BPs, it's a lot. There's a lot of money involved there, and but I'd say since it's going that fast, I'm saying like 3.25 on the top side. That should really cap it until Friday, in my opinion. Unless we get like really 0.5%. Or more distortions on the core or something, but it's I don't think we break those on the 10s. At least we break those ranges, but we have to look a little bit at the if we dive deeper into inversion or not on the whole curve. That's my opinion.
Yeah. And so, how do we trade it all? As Kay said, watching bond moves are very important because they're going to lead in this sort of data. So if you're trading FX, trading dollar, yen, euro, dollar, have a bond chart open, have US 10s open if you want the best generalized yield picture. But how do we trade it? It's purely about the price asking a question. If the inflation's hot, let's take dollar yen, and I like to use this as my dollar centric for data. If the data is hot, it's got to break some levels. It's got to break 137.50s. It's got to break the previous high. If it can't do that, that gives you at least some idea of what the market wants to do. It's saying, yeah, we're buying the dollar here, but there's something up here and we can't get through it. Typical price action, that's what you look at. I'm not saying you jump into a fade and say, right, I'm going to go the other way, but you give it some time. You let the price develop. You watch yields, and if the yields hit a level they can't break, 3.10% as we just can see in the last one of the last moves up here, 3.10. If yields can't break through that, then the dollar's unlikely to go any further forward. And you just let the price action develop. And if you start getting confirmed tops, then perhaps you look at a quick fade of that, because if it ain't going up, it's only going to go down. But there's no reason to go out on a limb with any of these trades. You keep a very tight stop loss. And if you get 10, 15 pips in the money, take some off the table, bring your stops down to break even or better, and just see where it goes from there. But from the wider fundamental picture, what inflation might mean to the overall trend in dollar yen, again, you've got to understand whether this data changes the narrative for the Fed wholesale, or it keeps them on their path. And if there's no real material change from the data, you can sort of put it in the rearview mirror, stick to the price levels that you see on your charts, and you just carry on trading the edges and the ranges and whatever you find develops in between. And the same can be said from the Bank of Canada today. They're expected to hike 75 pips from 150 to 2.25%. That's what the market's expecting. So your big price risk here for CAD is if they don't hike 75 pips, maybe they only go 50. But also what their view is moving forward, what they see from the path. Are they going to go more hawkish on the path? Are they going to dial it back a bit? We do have a presser because it's a monetary policy report. So we do have a presser, which I think is about an hour and a half after the meeting. So we will get some information from our mate Stiffers. Kay, what's your thoughts on the Bank of Canada?
Yeah, and I think it's pretty much, and it's, I hate to say it, but pretty much baked in that they will do 75. So today the disappointment will be 50. But that's for one. And then for two, they have been very hawkish over the past meetings. Their base economic data have really supported what they are doing. So to me, Bank of Canada is one of really the central banks who really took the bull by the horns and said, like, okay, inflation is out of control, but our economy can withstand what we are planning and going to do, and they're putting it in music. So in that respect, I think we need to respect them for what they are doing, and they're really putting their money where their mouth is. So we had this one reports, a labor report that we had last week. Some people may argue it's a bigger report, but all the job losses were concentrated in the part-time jobs, and but still, okay, even with a little lower participation rate, the unemployment rate itself came off, so they can easily hide behind that to just continue what they are doing. And I think this meeting, well, that's just my feeling, and they will not change anything yet. Okay, in the presser, it may be, so we have to be very careful, because between the statement, the decision and what's happening in the press conference, because McClem, if I recall well, he was like much more hawkish on the first statement, the first press conference when they started to hike. Then the statement actually came out, and today we might see a little bit of caution. So there's going to be twofold: there's the statement and the press conference. But if McClem doesn't change anything during the press conference, I think just don't change a winning team. Okay, dollar Canada is in line with other dollars, relatively high. We will see this see if this 130.85, which is a triple top or quadruple top now, gives way on any disappointment, or if it just continue, that we see Canada remain strong, but I would say mainly in the crosses, stuff like the Canada versus the ultra low yielders, such as the euro or the yen, just to name those two. So for me, it's going to be like get a disappointment. If I want to trade, it's rather going to be like, if they disappoint, I think dollar Canada blows up. If they stick with it and don't change a winning team, then I think Canadian dollar will continue to strengthen versus stuff like the yen and the euro. That's how I view it.
Yeah, no, I agree. And again, this is what you have to learn with central banks, particularly when they've got press conferences, is when you get that statement, you get an initial move. But then some can get lulled into a false sense of security because there's no follow through, and the price can mooch around a bit while we get the press conference. And then afterwards, you get a second wind. If there's no change in lines between what the central banker says versus the statement, then the market can kick on afterwards. So be careful, as Kay says, in between the announcement and the press conference and the end of the press conference, because it may look like the price has finished moving, but that might not be the case. For me and trading this one, I've been looking at this. I've had this zone on my chart for probably the best part of a year now. It's setting up a bit similar to Euro CAD that we've been speaking about, the 134, 133.90. It's got that near perfect technical touches, shows you how solid the level is. And I'm really getting itchy about whether to try a break trade through 1380, but I'm still very cautious about the margin I might get between trying to break trade at, say, 30.90 and running into some resistance around the big figure at 131. So I'm in two minds, and Kay mentioned it also this morning, maybe wise to leave the 130.80 to go and have a stop above 131 to see if it gets a real big blow through. But it's just for me, it's weighing up the risk reward, because I may be able to nick some pips, trading a stop loss at 85.90. But if I'm only going to get to 131 before it runs into trouble,
why are you saying 131? I think resistance is 132. That ascending trend line that you have. What's at 131?
If I zoom out to it's a bit of a zone. Okay.
Oh, okay.
Real big long-term zone.
Oh, gotcha. Okay.
Multiple points. It's not entirely clean, which is why I made it a zone rather than picked it as individual levels. But yeah, the top of the trend line, which is coming in at 131.60, 70, something like that. Yeah, that's another upsize. But if you're trying to break of 131, up to that sort of area, you might get some good pips out of it. If you get 30, 40 pips, all well and good. It's just looking at this 130.80, 131 part that I'm wondering if the risk reward isn't as hot for that point. But what you also look at is, what is the trend going into the numbers? So as we know, right now the dollar's fairly strong. It's strong against the euro, it's strong against the Aussie dollar, it's strong against the Kiwi. That's been happening for days. So if we do get a hawkish message from the Bank of Canada and we see the loonie drop and it drops decent, is that going to potentially have a fading opportunity? Because it's going against dollar CAD, it'd be going against what the dollar has been doing elsewhere. And that's the type of thing I also look at for trading. Does an event push a price out of kilter with what's generally going on in the market. So if we do get a big dip in dollar CAD, that's something I'm going to be looking at also for a possible fade. Maybe 129's a little out the way. So maybe around 129.5, I'll be looking that 50-60 area. But we also have to remember that dollar CAD can be very volatile over this type of thing. So, 100, 150 pips is not out the realm of movement for this pair. So maybe if we do get a move to 129 and I've matched all the announcement up with what's going on in the rest of the market, that may be where I look to have a long attempt and see what happens thereafter. Still, you got anything?
I've been looking at dollar CAD, and I personally on a 50 to do 50, which means that dollar CAD is going to spike on a spike above 138.85. I think that's a great. I'll be looking to get long there with a target maybe just below 130.170, which is the trend line. So I think this is a classic. Obviously, this. Of a breakout, and then 50 pips are going to come relatively quickly. So that's what I'll be looking to do. So a break of 130.85 on a 50. I'm going to get in long with a stop below. I'm probably going to give it like 15-20 pips as a stop, but be looking to get 60, maybe 70 pips on the upside.
Yeah, definitely.
I think that if as you were mentioning, Ryan, I said in the chat room, this 130.85 is now like a triple or quadruple top, but we have to be careful because and I'm not saying it for the price itself, because it's the level, it's there, because we've seen it. But I'm keeping in the back of my mind that those 130.85 offers may be somebody who is sitting with large to go up to 131. That's why I'm saying in my book it's going to be a bit of more of a safety, knowing that 131 also breaks, and then we are off to the races. I think if 130.85 figure breaks, the next stop could be 133, but that's only in a disappointment. And last thing I would add to that is that be careful, traders, for saloon doors, because we have the US CPI before. And
exactly. We're
Canada,
talking levels here, and they could be completely different.
Only 1.5 hours later. Yeah. So we could get up to this 130.85, 90 or figure even on the CPI, and then have like a massive reversal once the Bank of Canada comes out. So be a bit careful what you do before the Bank of Canada in dollar Canada. I mean, if I won't do anything in dollar Canada before I see the Bank of Canada. If I trade the US CPI, I'll do it in a different pair.
Yeah, and it's important to note that as well. This is a big solid level at 130.80, but we're 67 pips away, and that's not going to count for shit over something big in the Bank of Canada. So it's one of these times where you forget the level for the moment, let the price do its thing, see how it filters out, and then get in after once the dust has settled, and have we got a trend change? Have we got a different change intact from the BOC? And then you factor that into your trading. So big level, but 60 odd pips away going into a big central bank meeting. I'm not going to be betting the farm or putting any money on that. I'll let to see what happens. So still we're going to.
No, I was going to say wise words.
Yeah. Right, just a couple of questions from the rooms. Andrew, we'll take a look at cable, multi-year low. I think every day we come in, there's a new multi-year low, isn't it? But you're looking to try and get the bottom. Certainly 118 has shown itself up. So that is our potential marker for now, at least down into the low 118s. Given the volatility in this one, it's 120 for me. How it performs at 120 is going to be a big decider. If it holds below, then it keeps the downside, keeps the trend in play. If we do break above and hold above that, well, maybe we'll get some relief. But even right now, given the wider trend, 120 looks like a little step, even being such a big number. As far as the PM leadership race. I'm pretty much ignoring it at the moment because it's just noise. It's tons and tons of noise. This isn't about the voters. This isn't about the country. This is purely about political ambition and maybe some self-preservation about being in government. So all at the moment is completely political. Everyone's chucking out tax cuts and support and what they'll do as leader, and it's all pie in the sky stuff. I don't think the market believes it or is listening to it at the moment. When we get down to the final two, then that's when we can really start to make a judgment call, and probably the market will start to take notice. I think it goes down to this heat goes down to a 6 and then a 2, I believe. I'll have to double check that. So maybe when we get down to a 6, the market might start to turn its attention to it. But definitely when we get down to the 2, the final 2, that's when we can then make a judgment call on the pound. For me, I've always maintained that Sunak is potentially the most bullish for the pound because he is very pro-business. And just a personal opinion, I think he had a fairly good handle as Chancellor, particularly through COVID. So I think in the market's eyes, purely from investor point of view, Sunak would be the best for the pound. But that's not to rule out some of the others. But for now, I'm ignoring the noise because it's just blowing my mind and I can't be arsed with it. So until we get down to the final 2, let them all waffle on. Nick had a quick question based on US CPI. Wasn't part of the CPI based on used car prices last year. Yeah, that still has a big impact. I haven't checked the latest numbers, but I don't think it's come off that much. But as with CPI, there's plenty of other factors now coming into the numbers as well. So while we may see it coming off, and in fact we may not, there's still other factors that are coming in, things like wages and everything else, commodities still, and house building, the supply issues there, creating price pressures. So yeah, it may be a big part of it, and that'll be something we look at after the data's out. We can go through it and see what the drivers are, and there's going to be plenty of propeller heads popping up on the FinTwit to let us know. Like Mike says, rent as well is a big factor. But you can get yourself tied up in many knots looking at the details within a CPI report. At the end of the day, the market is going to move on the main numbers. That's going to bring the bigger price moves. But you're quite right to keep an eye on it and see what it does. Right, I'm going to let go on, mate.
Auto sales. It's a thing that I'm seeing every month. Calls from strats and people trying to read the CPI numbers that they think it's going to come off every month, and every month they've been proven wrong so far. So again, I've seen it. The anticipation is that it should come off again. It should weigh negatively on the CPI again this month. I've read it, but so far nothing has changed. So we have to look at it month by month, really.
Yeah. Again, back to the viewers. Kareem wants us to look at Aussie Yen. You got anything in particular, Kareem, what you're looking at? As I like to say in these shows, I can open up a chart, give you levels, but I want to hear what you're thinking. I want to hear your view. Let us know so we can talk about it a bit more detail. You're looking at a triangle there. Okay, we'll take a look at that. And quickly, the new PM is expected to be announced. I think it's September the 5th. So we're going to hopefully be whittled down, I believe, to the 2 before the July recess, which I think is the 21st, 22nd of July. So they're going to try and get it done pretty quickly in the next couple of weeks. I think the final 2 will come down set to choice September the 5th, but I'll double check that.
September the 5th, and they'll try to whittle it down to 2 for next Wednesday.
Next Wednesday, is it? Okay, yeah, which is, it's the 21st, I think. So, or 20th, 21st, just before the ECB. So plenty for euro sterling in that one. Right, I know I'm going to let the silver bugs loose now. So I don't know if Kay wants to take the chart still. You want to do a chart, or do you want to let Kay have them?
No, he can have them. I mean, I've talked about what I'm doing. I got filled yesterday. 1880, and I wait.
Right.
And for people who have been listening to us for a while, I've been waiting for this for a few months now. So one of the toughest things to do is to sit on your hands. I've managed to sit on them for quite a while. I think the time is right. I could be wrong, but I like it here. I really do.
Okay, can you guys see my screen?
Yes, sir.
Don't forget to enact it on the other one as well.
Oh yeah. Hold on a sec. There we go. I'm waiting for it to pop up.
There we go.
There we go. Okay. First of all, I had a question, and I've seen the anonymous attendee asking already twice about gold. So he must be in a hurry. So I'm going to do that one quickly. So as I've been saying over the past couple of days, short-term range 1722, 1752, but the bigger ones will be, I think we need to get back above 1770, 75 to call this one over. Even let's call it 1770, 1780. If we get back up there, we have a chance to revisit the 1800s. If we start to break below 1722 and keep below, all chances are there we're going into the big zone, which is 1670, 1680. To keep an eye on after all the CPIs, perhaps Michigan over, and if we can break below or we start to move up again. It's been like this traditional call for gold being the anti-inflation trade, but it would be the anti-inflation trade if there wasn't a risk of, and at least the market trading the risk of a recession. So we have to look at both things. If you have a high inflation but the economy goes well, that would, I think, be much more supportive for gold, and would especially be more supportive for silver. This is 1880, and or call it, because the channel has been moving down a little bit. This is Stells and 1880 around here. I've bought as well, and I'm still I already managed a little bit yesterday above 19 of my add-ons, and but I'm still leaving bids in this 1855, 1870 zone. Actually, I'm having a bid in at 1865 just in case I get something there. We have to be careful though, because we cannot rule out some extensions if we would go down to this 1690, 1710 area. It will always be possible, but therefore I think we will have to see negative growth, more negative growth coming through. If growth holds up, at the end, this is going to be one which is at least going back there, and I'm not doing the long-term call saying like it's a generational generational opportunity to buy silver at sub $20, but it might be in the end, but we will see. For the time being, it's hard to know what's happening in the next few hours, so I don't know what's going to happen in 2023, to be fair. Then we had this question. So yeah, the dotted cat, what I was looking at. Of course, we have this longer term as well. This top at 130.80. I think if it goes, there is this potential one. Potential. But you see, if you do a parallel, it's not going to work. It's going to take us as well into the 133s. I really think if it breaks here, we have a bit of a 200 point to possibly go up. But that would be only in a case of Bank of Canada really disappointing today, in my opinion. The other one I'm really keeping a very close eye on, as everybody knows, is the Euro Canada. We are testing this 130. There's for this afternoon. sorry for my chart being a little bit messy, but this is 129.90, which is close enough to 130. It's going to be, it's the new 133.90, 134, the figure. If this afternoon we breaks up 129.90, I think we are going for the next leg. On the top side, I would say watch 130, 130 for if we get above there. It's been a bit of a retracement zone as well of late. If we get back above there, maybe in for deeper retracements.
Υπολογιστής τα 2 τα μετά, 3 η ώρα. Εντάξει.
Figure, which will be interesting. So, but this is one I think after the Bank of Canada to really keep a very, very close eye on. Then the other ones on the EM, the last dollar leg, as I was pointing out, has seen emerging market currencies come under pressure, and I also think it's a combination of factors. Of course, we had a technical breaks through channels. We had the dollar strength on the one side. We had a few more technical breaks. We have this repricing of the curve, where yield curves are starting to go negative, which is an expression of expectations of economy slowing down, possible negative growth, and slowing down economies is traditionally not good for emerging markets, where regardless of where their interest rates are. But okay, it went, dollar max went up to this resistance line and capped. But we are still not miles away. We are still in the 2080s. So we will have to see on the CPI number if we can break back above 2090-92. And if we get a confirmation above 2103.04, there is a risk of this dollar mix at least to go push a bit higher. If in turn we start to get back below 2075 and with a confirmation below 2065, I think, and then 2060 here, it's probably game over, and we are starting to go lower. So there's a few decent levels to look at. It's within 1%, which is not massive in the emerging market currencies, within 1% of range to look at. So this is not massive in EM terms. So keep an eye on those levels. The other one, which I'm still running a part of, is my Euro mix. I'm still a little short of it. I want to see the data come out before really make a decision on this one. I was ideally looking for a move back up in between those two lines here to start adding to shorts again, because I think it's still not over. Okay, it depends on the ECB, of course, next week as well. But if the ECB just does 25 and then goes for 50, and if they don't really surprise us, I think the interest rate differentials are going to stay, and this is one of the biggest differentials. So I'm still overall bearish this one. I do think that in the end, well, I do think this is my plan anyway, that we are going back to pre-COVID levels, mainly helped by the huge interest rate differentials. And as I keep on repeating, watch the economic data. If economic data really start to turn sour, then those EM plays are going to be very risky, because emerging markets don't like global recessions. So, but as long as we are there, we are not there, I mean, and the economies are not completely falling out of bed, I still think this is a pretty decent trade. And then finally on the rand, yeah, it's the same actually as in MEX, with that addition that there's again some what is it, Eshcom threatening electricity cuts and stuff like that. So that's weighing a little bit more on the rand. I'm not really looking at doing much in it right now, because we've broken this triangle and it's been relatively strong, this move up. We really need to go back below 1650 to start to turn the ship around, in my opinion. But pay attention to 1735, 1750. This is another decent resistance, so pay attention to that one. But for the time being, I've got nothing in there. Anything else you guys want me to look at? Or
yeah, do you want to have a quick look at that Aussie Yen?
Yeah, sure.
And also to some of the Eightcap traders, Sam P wants a little look on dollar Swiss. Again, please let us know what you're looking at, what your view is, so we can factor that in when we're talking about it. And hi to Annie Rude, I think. Hope I pronounced that right, from Eightcap. So welcome to the show. I'll let Kay have a look at that now.
Sure thing. Yeah. So exactly, the Aussie Yen is in a triangle, and it depends where really you wanna place it, because you could eventually argue it's there, but we only have 2 points here. We have been like trading a lot of touches, break, could be a false break, and then back below. Yesterday, big correction, where it even broke below the downtrend line. But if you look at the what we've really been doing inside here is, did I already put that one up? It looks like a duplication, yeah. So what we've really been trading is those low 92s versus the 93.25. Tried to break and then fiercely reversed, because the dollar yen also came back up, and Aussie got that that breaks up the 67.60 50% retracement of the 2021 move, right? Which has been reversed actually right now. Yeah, I'm watching it, but you have to really see what the commodities are doing, right? I mean, and that's going to be your ultimate driver of this. I would still argue, because I think commodities could find a bottom not too far from here. I would still argue this is well oriented somewhere to go higher, because you could also argue that we are still in a longer term or in a medium term bull flag, this whole thing. But yeah, in the short term, if we start to break, I'd say above 93.35 again, we get the confirmation. We could move higher again, but I think for the time being, dollar yen will be a cleaner thing for me personally to trade. The one that I'm keeping an eye on, though, is the Canada yen. We've been like, it's been a bit complicated here, but if you look at the long term, we're still, from when this flag has been broken, we've actually never even had a retest. This thing, to me, for as long as oils are keeping up, relatively up, and the commodities are not going down, and today with the Bank of Canada, in addition to it, if we start to break back through 106, this could start to do the next leg higher, in my opinion. So, but we have to look at what the Bank of Canada really wants to do today. So that is mainly it.
Do you want to grab dollar Swiss? And then there's a quick question.
I haven't looked enough.
It's popped. Quick question from Catherine. Which pays the better carry, dollar rand or dollar mex?
It's the mex. The mex interest rates are now at 7.75, and if I recall correctly, I can quickly check for you. But the setup
4.25 the rand.
Yeah, and 7.5 on the mex in the short term. But if you look at in the longer term, the rand yields are much more explosive. The curve is a lot steeper. But so if you look at the 10s, they are basically where the MEX stands are. But if you look at the shorter, if you look at the central bank rates, the MEX is way higher than the rand rates. So the carry for us day-to-day traders will be better in MEX, if you will. Dollar Schweiz. I haven't really looked at dollar Swiss too much lately because I'm been more concentrated on the Euro Swiss myself. Because take away the Euro Swiss, dollar Swiss is just a proxy of euro dollar basically. So so if Euro Swiss moves, it's going to tell you where dollar Swiss is going. If you have a pretty good idea about what euro dollar is doing. So I'm not a huge fan myself of trading dollar Swiss, but if you really if you are a fan, I can always have a look at it. Yeah, we had this double top just above parity earlier, and since then those two drops is just euro Swiss, because if you look at it, euro dollar is near its 50 points of its lows, but the dollar Swiss is still trading two big figures below its highs. So it's purely a euro Swiss or Swiss franc move. I think parity is always going to be or call it parity or no, yeah, parity or 1005060 is always going to be a pretty decent level. And as we see here, 95.5, yeah, we went back below a little bit. We had this one, 94.75, 95 the figure, 95.5. This 94.75, 95.5 is looks to be pretty important to me as well. But that's as much as I will. To be fairly honest, I'm not even looking at dollar Swiss. I don't trade dollar Swiss, so but we are in between here. Your midpoint, your pivot point will probably be 97.40.50. If it goes back below 97.40.50, we have a chance to get back down here, possibly. But therefore, you will need to have help, in my opinion, from euro dollar as well, perhaps holding parity, which would be a good thing, because euro Swiss is still making new lows. Today we hit another new low at 0.9807, which is, to me, the more interesting thing of the two.
Cool.
Okay.
Yeah, we'll be back quickly, and it won't be too long because I know we've been keeping these guys and girls for nearly an hour now. So let's grab on there and on there. So just quickly for our viewers from Eightcap, if you want to come and join us on the show, please come to ForexAnalytix.com and look for /webinars, and you'll see what we offer, because we offer several webinars during the day. Some are for subscribers to our chat room. The Flow Show is a free webinar, so you can access that, and you can register to come and see us every day there. If you do want to come and join us in the platform and get access to all those other webinars, you can do so coming to forexlive.live/platform, or look for Traders Platform. Give you all the information about our chat room and the products we offer on our dashboard. You can also grab a 20% discount for the lifetime of your subscription from this link here. That's purely exclusive for me at forexflow.live. And just to, as I say, going back to a couple of other pairs, and someone's asking about oil. I think I missed this one. It hit a big level. WTI hit a big area that we've been looking at for a long while, down towards 94s, 92s. This zone here, I've not got it coloured, but between these two lines, happened late last night, so I missed it. I don't like, really, some things I don't like trading if I'm not in front of my screen. A big support zone that I know a lot in our chat room been looking at, and we've had a pretty decent bounce off there so far. But for oil generally, this is one of the big areas to watch now. Quite a solid support area. the thing with oil is it can be quite volatile. You can't, put anything right on a number on a level. You've got to give it a good 50, 60, 100 ticks either side sometimes, such is the volatility in oil markets. But that's the level I'm looking at there. Another one quickly, Euro Sterling. I was completely off the ball for this one this morning. We got a dip in Euro Dollar, got down to test that parity number, 1.006, I think it got down to in the lows, and Euro Sterling got into this support zone that I've had, 84.20, 8400. I was looking at that for long, but as I say, I completely had my foot off the gas this morning, completely missed that one. But the euro has solidified off that parity level once again. It was a bit of a sharp move this morning, so I'm not sure what went on there, if it was just a bit of a flow move, maybe an order, because it was quite a sharp move down towards it, and then quite a sharp move back up. And if you blinked, you missed it. But it has solidified the area again, so this is still our big key point down at parity. And so far, the market's keeping the wolves from the door. But short term, we've got to get above the steps. We had some minor steps that I flagged yesterday, 36, 35, 40. I can probably take that line out now because it's not become much. Little bit of action against the next line in the 50s. Can't really get above and hold. The number after that is up in the 1.0070s. Small steps, but it's the small steps that need to be taken before you start making the big steps. But anyway, thank you very much, as always, to the guys and girls from Eightcap who are joining us. As again, please do come and join us on the show daily. Thank you to all our regulars and any newbies who come to the show day to day. Always good to see you. Always good to hear your views. Good luck on the day to today. Be careful. I hope you make many pips. And we shall see you tomorrow for the aftermath. And thanks to Stel and K-Man for their input as usual.
Cheers, everybody. Thanks, Ryan.
See you all tomorrow.
Okay, man.